Everyone, welcome to Blue Dragon Universe, right? And thanks for registering in CP2 course. This is the first video. Now, in this video, we are not going to touch any chapter. Obviously, our process for SP2 would be to cover the chapters in such a manner that you don't need to go back to the book or may not require to do something significant in the from the book, right? Or record to study. So we'll cover that. Sometimes the books are very wordy, and that's where my experience will come into picture where maybe the wordiness can be removed and we can only concentrate on the important portion, right? Sometimes every word in that book is important and we need to go through each and every word, right? Maybe in the first 9 chapter those things would be very important, first 9 10 chapters, because each and word will be important. Then you can, then the wordiness will come into picture. That's how SP2 or any other higher paper is structured. However, before we start doing that, today would be a very important video, right? The reason this is very important because I'll keep going back to this sort of points, and every time I don't want to explain that, right? Because then that would make the length of the video very big. So because these are very few important points, and these are few points and these are also very important points, so that's why I need to cover this at one go today, right? And you need to, like, whenever I say something from this, I mention that, yeah, you need to go back to the key equation or key points video, and you need to kind of see that video in case you are not able to understand or remember, right? So I think this video would be a slightly bigger video, maybe around 45 1 hour video, and you need to pay utmost attention because this is where the crux of SP2 will lie, and these are the concepts that will be repeated or might be used in different chapters, right? So without further ado, let's start. First of all, this equation you should remember from the CM1 syllabus. This one, maybe also underline this and make it italic. So this is called equation of value or time zero equation. This means at time zero, just when the policy is enforced, right? Underwritten, after underwriting and after the new business things have been done, the policy is issued. That is the point we are calling it time zero, right? So EPV of premium, that is expected present value of premium, is expected equal to expected present value of benefit plus expense plus profit. So premium consists a portion of the profit, right? Otherwise, why would our insurance company write that product, right? So obviously that is called EPV of premium is equal to EPV of benefit, EPV of expense, EPV of profit. Now this equation is usually used using or written using the pricing basis or pricing assumptions, right? And pricing assumption and reserving assumptions is usually different. Pricing assumptions usually closer to the best estimate basis, or it might also be an optimistic basis. But reserving assumption in Indian scenario, or what you will study in SP2, would be in prudential assumptions or would be much prudent. However, in IFRS 17 or Solvency 2, we have moved away from prudential assumptions. But that is maybe that is a SA2 topic, not SP2 topic, right? So we'll not go into that. Whenever we are talking about reserving assumption, just ensure that you think about the prudential assumptions, and whenever we are talking about the pricing assumption, just ensure you are considering the best estimate assumption, right? Whenever something is different, I'll explain or I'll mention that. Now if I just rearrange this equation, right, then EPV of profit, this is also known as VNB or value of new business. We'll also see this term in later part of SP2, right? But there is very limited information given in the paper, and once again, that is why for this sort of papers, people who have worked would have much edge as compared to people who have not worked in the industry, right? So if you are working in a life insurance company, then this paper would be slightly easier to you as compared to someone who has just cleared 9 papers thinking that, oh, this paper would be similar to the 9 paper, let me attempt. This would be slightly difficult for you to understand, right? Now without uh, my job is to kind of make it much easier for you even if you have not worked, right? So EPV of profit means this value, you are rearranging this equation, right? That is also known as VNB, value of new business. Now this can only be determined at time zero, right? EPV of profit at t equal to 1, t equal to 2, t equal to 3, that is actually known as reserve. We'll come to that, right? So EPV of profit, that is only defined at time equal to 0, that is also known as VNB, right? Whenever it is at time equal to 0, if it is time equal to 0 plus just slight amount other than 0, right, then you cannot call it you cannot call it VNB. It is defined at the point of sell. You have to remember this, VNB is defined at the point of sell, right? So point of sale means selling the product, right? So VNB equal to EPV of premium, obviously. So when you are kind of sorry, not EPV of premium, that would be EPV of profit equal to EPV of premium, right? And this would be EPV of benefit. Let me change that. Both the things are written as premium. So this would be EPV of benefit, and this is EPV of expense, right? So I have kept this quantity here, and I've removed. I'm kind of moved this to the other side, right? That's just interchanging the terms of the equation. I think if you are studying SP2, you know that much of mathematics. So I'm not explaining that further, right? So EPV of premium equal to EPV of benefit, EPV of expense. This means that this will only give you profit if the expected present value of the premium is higher than the combined expected present value of benefit and expense, right? And if a product is written on a best estimate basis, you will expect or in a best estimate basis, you will not written on best estimate basis. What obviously it will be like kind of priced on a best estimate basis. So on a best estimate basis, you will expect that the product will give you profit, right? And the expected present value of the premium would surpass the expected present value of benefit and expense. Otherwise, there is no point in writing a product, right? So that is called VNB or value of new business. Remember this once again. VNB is determined at point of sale or T equal to 0, right? So these are the things that you need to remember, because these are the topics that will be kind of referring to multiple times, right? Now time T greater than 0, this same equation, right? This same equation is known as prospective reserve. Instead of writing that as EPP of profit, we are calling that prospective reserve, right? And in this case, because reserve is a negative quantity, right? It's a liability. Reserve for life insurance company is a liability. So we have just changed the sign, right? So if you just put a minus sign and cover it under a bracket, you will get this equation: EPP of benefit, EPP of expense minus EPP of premium. So this means that your reserve consists of your profit, and it will be released over a period of time, right? Because this equation and this equation are exactly same. Because it is liability, it is written with a negative sign, right? You can call this, like, I'll not write this, I'll not save this, but this is exactly this equation, right? Prospective reserve is exactly this equation, negative of this equation. That is the prospective reserve. I'll just remove that because this is not correct, and this will be uploaded. This word file will be uploaded along with the video. So it might give you a wrong impression if I keep that. But I think the concept is clear. Because it is a liability, and it is written with a negative sign, right? And EPV of benefit and EPV of expense, negative of this, right, minus EPV of premium. So that's why reserve consists of your profit. When and as and when the reserve gets released, right, the profit gets released. Because reserve getting released means the profit is kind of getting realized, right? So once again, we are back to at T equal to 0. Once again, we are back to the point of sale or T equal to 0. NB trend, which is the new business trend. New business trend means the the cash flow that occurs at that point of time. So obviously you are keeping prospective reserve. That reserve you are keeping at prudential assumptions. So that is prospective reserve at T equal to 0, right? At T equal to 0, prospective reserve, which is equivalent to this value, right? But because it is written in best estimate, this is written prudential assumption. This value would give you in this case, right? Prospective reserve would give you a positive number, because otherwise this value at T equal to 0, EPV of profit would give you a positive number in this case, right? However, when you are writing the reserve, that will give you a negative number, because because reserve is a liability, right? But in this case, so you are supposed to get a negative number here, right? Prospective reserve, by that logic, you are supposed to get a negative number. But because it is written on a prudential basis, this value would increase, this value would increase. Because it is written on a prudential basis, you are artificially or inflating the liability, right? And that because of that, the prospective reserve at T equal to 0 would give you a positive number, right? The initial expense, obviously, and the initial expense is not part of prospective reserve, because prospective reserve means looking into the future, and initial expense is kind of incurred before the prospect, before T equal to 0. That's why I've written T less than 0, because prospect initial expense would be the underwriting expense, the new business expense, calling the customer for filling the proposal form, etc., etc., and that is done before the point of sale, right? So before the policy is issued. Policy issuing means point of sale, right? Because that is the point where the policy has been issued, right? That is the point where the sale has been generated. Because otherwise you might have to refund the premium if the life is a substandard policy, and then that is not a sell, right? Basically, that is not a sell. So that is prospective reserve. This is a big positive number, right? Because of the the prudential thing, initial expense, this will also be a big number, and you are getting just the premium at t equal to 0. Here you are not calculating the EPV of premium, right? Because you are calculating the cash flow at that point of time. You are just calculating the premium t equal to 0. Now, if this is a single premium, then this premium would be higher, because the single premium would consist of, because single premium would have this, all of this incorporated. This will be slightly higher. Chances are that it might be greater than this two, right? It might be greater than this two, and negative NB strain might be negative, which is a positive thing for the company because it represents a strain. So that would mean that there is no strain. Basically, the NB strain negative means there is no strain. However, chances of that happening is rare, right? So there, the possibility would be that because of this big figure, and this is also quite a big figure, the premium, which is usually the premium would be regular premium, and even for single premium cases, this two figure, this two positive figure will be far bigger than this figure, right? That would cause NB strain to be positive. That means there is a strain. So whenever you are selling a policy, there is a strain. The company has to put money, or in this case, say shareholder has to put money to kind of finance a sell, right? That is where life insurance is different from a other product. In other products, for example, my famous example is a chocolate company. Suppose you have a chocolate company. Whenever you are selling a product, right, you are generating some profit, because you are manufacturing the chocolate maybe at 20 rupees or $20, and you are selling it at $40, right? But whenever you are selling a life insurance product, you're incurring a strain. Like, you have to pay the policyholder money, something like that, right? Or the shareholder has to pay money to the company just to sell the product. So that's why over a period of time, this will be realized through this prospective reserve equation. When the reserve get released, the profit will be realized. But at the point of sale, because of the prudential assumptions, you are incurring a loss, or whatever you can say, NB strain at that point of time, right? So I hope this portion of the equation is clear. If it is not clear, you can write me an email. I think that is, you can go to the contact us section of the website and write an email, right? And I can respond to that. But I hope that this is clear, because I have explained it vividly. And if you pay slight attention, maybe if you are not clear, maybe rewind this section, and if you can play that, I think you would be able to understand what I've just meant, right? So that means few of the key takeaways is VNB is also the EPV of profit, but at t equal to 0, right? At time equal to 0. At time greater than 0, then VNB is changed to prospective reserve with a negative sign, because it is, one is profit, one is something else. And at time t equal to 0, NB strain is equal, NB strain denotes the cash flows, that is equal to prospective reserve, right? And this is supposed to be by this logic, this is supposed to be a negative term, but this is not negative because of the prudential assumptions, right? And finally, we have the initial expense, right? The initial expense t is less than 0, and minus premium t equal to 0. The premium would be usually regular premium, which is a small premium, but even if it is a single premium, these two numbers would be far big, so that obviously there will be some initial strain. Only if the reserving is on best estimate basis, then there would not be any NB strain, because this number would be negative on its own, and this would be the biggest number out of these three, right? So that's when IFRS 17 or Solvency 2, there is no initial strain if the contract is written on profitable term. If the contract is not written on profitable terms, if sometimes the contract may not be written on profitable terms just to capture the market, right? So in that case, there would still be NB strain. But if it is written on profitable term, which is the normal expectation, then obviously there would not be any NB strain, right? But for our purpose, we'll assume that we are working on Solvency 1, or before that, like maybe IFRS 4 also, and the reserve is kept on prudential basis, and there would be NB strain. So NB strain arises because the reserve is kept on prudential basis, right? Moving on. Few important points. Asset share is similar but not equal to retrospective reserve. Now, asset share, as I mentioned in the second point, is a piggy bank. Piggy bank means piggy back, not piggy back. It's piggy bank, right? So what asset share means, like you remember earlier when we were kids, like we used to have some. I used to have a box where I would save money from wherever. If I visit a relative, or if a relative visit us, then they used to give us 100 rupees, 50 rupees, and I used to keep that, right? And what my parents used to do is, whenever they run into some financial difficulty, whatever money I have kept there, they will borrow from there. And whenever that difficulty is done, they will put back the money, right? But they would never pay me interest because they are parents. So I lost a lot of interest value. I'd be a millionaire by now if they would have paid me the interest. Anyways, so asset share is something like that, similar thing, right? Why is asset share is kind of kept? We'll see that in just due course. But asset share gives you the amount of fund that is accumulated for a particular policy at a particular time period. Say it can say, like you can say, what is the asset share at 31st March 2024? It will tell you till that time period. Suppose the policy has been issued on 2020, 31st March 2020, 4 years have passed, and after the four years, what is the fund that has been accumulated for this policy? Because that policy incorporates some commissions, the policy has some expenses, and the policy also has some kind of uh, maybe the policy also has some underwriting expense, etc., etc., right? Or considering all those expenses, policy also have premium coming in, which is a positive thing for the company. So considering all of this, what is the asset share, right? So that asset share will indicate the fund that has been accumulated, right? Now the second point is, and it is similar to retrospective reserve, right? Similar to retrospective reserve, but it is not equal to retrospective reserve. Retrospective reserve, I will not go into the formula, but you can check the formula, and it is, you can easily find out how the retrospective reserve looks, and what is the, how what is the structure of the retrospective reserve, right? It is kind of similar concept, because in retrospective reserve we are looking backward, not forward, like in prospective reserve. So similar concept happens for asset share, because you're looking backward, because every actual thing that you have realized, that would be kind of considered in asset share. But asset share do not consist of everything actual. Something can be it's on expected basis as well, right? And that would also be kind of considered. But however, for our purpose, we can consider it is similar figure or similar conceptual figure as compared to a kind of retrospective reserve, right? So whenever we call about or talk about asset share, you can just have that reference in mind, that asset share is like a retrospective reserve, right? Now, any saving policy will give surrender value as it stores time value of money. Why? Why? Because your premium can be, or benefit can be split into two parts. One is the protection component, one is the saving component. Now, this saving component will act just like a saving account of a bank. So in bank, you put some money, right? And you expect 4% interest per annum or 6% interest per annum. Why? Because you've kept the money with bank. So it is, the bank is supposed to give you some interest. Similarly, your premium would be split into protection component and saving component. And I've already, if you have seen my YouTube channel, I've already made a video on this with much more vigorous detail. I'll not cover that much detail here, but I think you will understand for our purpose. So in that case, what can happen is the you are like suppose your premium is $100, and out of the $100, $80 is for protection, $20 is for saving. So that's why your product has to be a saving product, and out of that, so $20, you are giving some money to the, like you are giving some money to the insurer, just to give you some protection, just to give you some saving component, right? So that money is just like a saving account, and the insurer, based on the insurance investment return that insurer has generated, they have to pay you back some money, right? So that's why there is a surrender value. Surrender value does not arise from the protection component, but it arises from the saving component, right? And over a period of time, the surrender, it might become so big that it can surpass the protection component, because you are giving premium every year or maybe every month, right? So there is a consistency of the fund inflow, and if that is kind of invested properly, then that can surpass the saving component, right? So any saving policy that has to provide surrender value, because there is a time value of money. Our protection policy, like a term policy, they do not provide surrender value. There are other reason as well. There is anti-selection, etc., and we'll cover that in the underwriting chapter. We'll cover that, so I'll not go into detail. But you need to remember this, that any saving policy gives surrender value because of the time value of money, right? Now reserved is a, now in the first chapter you'll see they will talk too much about reserve and asset share without hitting on the point why reserve is kept and when asset share should be used and when reserve should be used, right? That is the most important point, and they tried to touch upon that, but they have failed to convey that communication, as per me. Now, why reserve is kept? Reserve is kept for the entire duration of the contract, or if a contingency event happens. In this case, it is death, right? So reserve is kept for that. Reserve is not kept for surrender, lapse, etc., etc. Although your reserve can have assumptions for that, right? But reserve is kept for that entire time period, right? Reserve is kept till the policy is in force, or reserve is or there is a contingency event, that is death happens, right? So that's where reserve would be used. So whenever you are talking about death, you will be talking about reserve simultaneously, right? But asset share, because it's a piggy bank, right? So asset share is kept for if the what happens if the policy terminates midway. So that means that the asset share is used to determine the amount that is accumulated. So that means whenever you are dealing something with the amount, like if the policy terminates midway, what is the surrender amount you have to pay? Or in case of with profit policies, what is the amount of bonus that you have to pay? Whenever this amount term is arising because of the midway calculation, the policy is midway, right? Because of that, asset share will be, or whenever that situation arises, asset share has to be used, right? But whenever there is something related to maybe the number of deaths, right, or the number of surrender, in that case reserve would be used, right? So that is the clear distinction between asset share and number. Asset share is related to the amount that, and whenever that discussion arises midway, right? But reserve is related to the number of deaths, number of surrenders, number of lapse, and that is how the asset share and reserve is kind of calculated. Anti-selection is a very, very important term, and anti-selection, you will see anti-selection probably 2000 times in this entire course. So anti-selection basically means misinformation. So what, because you are more aware of something, maybe you are more aware of your health as compared to the insurer, you are providing the insurer with wrong information, and if you are not getting caught, right, then the insurer will charge you less premium. Because of that, the insurer will be making a wrong selection for itself. The reverse might also happen, which is also an example of anti-selection. You are more aware of your health, you know that you are in good health, right? And then you have purchased a term product, and then you think that, yeah, I'm not going to die within this term. If the insurer offers me some value, let me leave the portfolio, right? So if there is a surrender value in term product, although there is no surrender value in term product, but if the insurer provides some surrender value, you will take that surrender value and leave. In process, the insurer will be left with bad risk, or people who are more likely to die. Those are the people who will never leave, right? Never take the surrender value, because they know that if I leave midway, I'll be letting go of the bigger death benefit, because death benefit is much higher as compared to the surrender value, because surrender value once again is calculated based on the asset share, because it is a saving component, right? So you will calculate the asset share at the midway stage, you will determine what is the asset share. Based on that, you will make the payment of the surrender value, because it's a midway termination, right? It's not the contingency event. And that's why whenever you are doing that, right, whenever you are doing that, so that means you are withholding information to yourself, and the insurer is getting penalized for that, because the insurer do not have more information about yourself than you yourself got about yourself, right? So that is anti-selection. There is only one way you can counter anti-selection, that is proper underwriting. That you do medical underwriting, you do the financial underwriting, other all sorts of information verification. So that is the only way you can counter anti-selection. Underwriting is done to counter anti-selection. That is the main point, right? Solvency capital. Okay, sorry, we missed the mortality risk. The mortality risk, as we know that we are in life insurance, this is one of the most significant risks. Especially mortality risk is more significant for protection product like term product, right? Or longevity risk is more significant for annuity product. However, for saving product, investment risk is more significant, right? Because in that product, there is time value of money. As I mentioned before, time value of money can grow big. Because the time value of money can go so big, right? It can give the insurer much more higher return as compared to the mortality one. So that's why that is more important, right, for a saving product. Now, mortality risk can be mitigated through underwriting. Obviously, if you underwrite well, then this anti-selection will not happen. Then your mortality risk reduces. Or you can take reinsurance. You can keep low retention level, high retention level. Once again, that is a chapter, and we'll cover it there. But you need to remember, mortality risk can be countered by only two things. That is underwriting and reinsurance. There is in fact another thing, that there is something called mortality derivatives. You can purchase that, but usually that is not available, especially in the Indian scenario, that is not available, right? Solvency capital required solvency capital, that depends on the riskiness of the product. From where riskiness will generate, from the guarantees that is provided. For example, you have a unit link policy, you are giving a guarantee of 4% per annum. Wherever the market goes, you are going to give 4% per annum. This is a financial guarantee. causing issue, right? Suppose you have a term product and you are saying that you are the policyholder can renew the term product for 10 years without any medical underwriting. That is a sort of guarantee, right? You are giving the guarantee to the term policyholder that for a term product, the sum assured can be doubled without any medical underwriting. That is a mortality guarantee, right? The first ULIP example was a financial guarantee. The term increase or the sum assured increase, this is a mortality guarantee. So all of these guarantees increases your solvency capital, right? So solvency capital is measures the riskiness. Like the more riskier the product is, the more the capital that is required, right? However, determination of solvency capital might vary. Like in India, we have factor-based method, so it will just multiply with sum at risk, some factor, and reserve with some factor. That will be the solvency capital. But the more we move to the best estimate basis, we are moving to the solvency risk-based solvency capital, also known as RBC, right? And that is also because in best estimate basis the reserve would be negative, right? Because of best estimate assumption. If the reserve is negative, you cannot keep a negative factor of negative thing as solvency capital, right? So I think if you understood this portion, you will understand, because the reserve in this case would be the expected present value premium would be higher, because it will be similar concept here, right? So because of that, the expected prospective reserve would be negative at the start, right? And as it goes along, when the mortality increases, the reserve would start becoming positive. But initially it will be negative, right? And because of that, there will be no invis trend, right? Once again, we are going back to the same topic. So because of that, the solvency capital would be like you cannot keep solvency capital by factor-based method. You cannot keep a negative capital, right? So you have to kind of calculate it based on risk-based capital method. Once again, risk-based capital is not covered properly in this chapter. It's a SA2 concept in SP2. So don't worry about risk-based capital. Just understand that solvency capital is dependent on the riskiness of the product. Riskiness comes from the guarantees offered in the product. Okay? Free asset or capital, that is equal to total capital. Total capital means whatever capital the shareholder has put, right? Minus the reserve, that is your liability, right? Reserve and liabilities are the same thing, minus the solvency capital. So if you take out all of this thing out of the total capital, you get the free asset, free capital. This you can invest anywhere, in bonds, in equities, anywhere, right? And the last point is, which is the most important point, where I have seen most people, even experienced people with 10 years of work, 8 years of work, have no idea about this. That is, reserve has no physical existence. Reserve does not exist physically. We calculate it mathematically, right? That is why that prospective reserve or whatever that formula is, that is required, because there is no physical existence as compared to a chocolate company where your liability is physically existing, right? Because this is a service industry, that's why the liability is kind of do not exist physically. And that's why actuaries are so important, right? Because had the liability been existing physically, anybody can say that this is the liability, right? For example, chocolate company, the number of chocolates that are unsold, those are the liabilities, right? But in a service company, or in a there is no inventory, right? In a service company or in a life insurance company, so you have to mathematically calculate what could be the liability, and that's where the assumptions comes into picture, right? So reserve has no physical existence. It is calculated mathematically, and some amount of money is kept aside from the total capital, and it will be invested. There will be regulations on that. Mostly it will be invested in government bonds, corporate bonds. It is, you are not allowed to invest that on equity, right? Because you cannot look for higher return. You are just looking for preserving the capital for that investment, right? That's why higher the size of the reserve, higher would be the investment return coming out of the capital kept, because the return cannot increase, but the base can increase, right? So that's why endowment or term, endowment or whole life, like this, these have higher reserve as compared to term, and they would give higher. That's why these are saving product. That's why they would give higher return, right? So I think this, the key equations or key point is covered, right? And this is one of the most important video. I will say the most important video. If you have not understood this, you have to rewatch this video. If you have still not understood something, write us an email, right? And I would try to respond in 24 hours. But I hope that I have explained it well, so that you are able to understand that, right? And these are the concepts that I will refer from time to time. I'll like come back to this portion, and then I'll say, I have do remember this is what we have spoken about in chapter 1, or maybe in chapter 2, or maybe in key equations, right? So this is how I'm going to refer, right? So that's why this video is a very, very important video. If you have understood this, I think 30% of SP2 is over, right? Because these are the same concepts that will come, and I'll just keep on reiterating this concepts, right? So see you in future videos.